We do have some approval of minutes to make, but we don't have a quorum just yet, so we'll go ahead and get started, and when we get that quorum, we'll step to the side and do that. But I'll ask the clerk to please call the roll.
Senator Rocky Adams, Senator Douglas,
Present.
Senator Girdler, Senator Howe, Senator Neal, Senator Schickel, Senator Smith, Senator Storm, Senator Turner, Senator Yates, Representative All, Representative Bentley, Representative Bray, Representative Duvall, Representative Frazier Gordon, Representative Gooch, Representative Justice, Representative Lewis,
Here.
Representative Lockett, Representative McPherson,
Present.
Representative Pollock,
Here.
Representative Rourke, Representative Roberts, Representative Rudy, Representative Smith, Representative Stevenson, Co-Chair Carpenter,
Here.
Co-Chair Meredith.
One
Yes,
more.
sir.
One more after.
We appreciate everybody being here. We need one more before we get a quorum to do our minutes, but we'll go ahead and get started now. Got a good agenda. Shouldn't take too long, but it's informative. So the credit union industry, I think, is here. If they want to step up to the table and give an update, I'll have all you guys, all familiar faces, introduce yourself for the record, and ever how you want to proceed forward, I'll allow it. Good to see you all. Thank you for coming.
Good morning, Mr. Chairman and members of the committee. Thank you for having us here. We appreciate the opportunity to speak. My name is Kyle Haggerty. I'm from Kentucky's Credit Unions, our trade association. I'll let these two gentlemen introduce themselves, and then I'll get started.
My name's Larry Lucas. I'm the president and CEO of Ashland Credit Union.
Good morning. I'm Jim Cash. I am president of Kentucky's Credit Unions.
All right. So, again, thank you all for being here. Thank you for the opportunity to speak on what credit unions are, how we are working to better the lives of Kentuckians, and why we do that. I'll give some brief remarks and then throw it over to these gentlemen. As a bit of background, credit unions are uniquely structured, distinguished by their not-for-profit status, where all earnings are returned to their member owners through the lower rates on loans, higher rates on savings, and generally less and lower fees. Right? And I said member owners. Credit unions are not-for-profit, member-owned financial cooperatives. Member ownership is based on the principles of democracy, democratic principles. Each member of a credit union has one vote in its governance, whether they have $1 in their account, $100,000, anywhere in the middle. Equal vote on the governance matters. This unique structure has proven over time to produce a plethora of rewarding outcomes for those member owners. Specifically, in terms of rewarding outcomes, just in Kentucky, there's over 6,000 jobs directly supported by the credit union industry. Short-term loan rates, just as a couple of examples, short-term loan rates are on average 400% lower than competing sources of those short-term loans. And even in the face of economic trends pushing towards consolidation, centralization, and the tough market that we all see, Kentucky credit unions have been able to add branches and bring the benefits of member ownership in one's financial institution to 24 new counties over the last 10 or so years. All that said, Kentucky has 56 of its own credit unions, 18 state chartered, 38 federal chartered, all focused uniquely on uplifting their member owners and helping them achieve their goals of financial well-being. In service of those goals of financial well-being, I know all 56 could tell any number of stories of individual members, programs they're offering, ways that they really put into action that not-for-profit model. While all of them could tell stories, I know that Larry and Jim are eager to tell some of their own, so I will hand it off to Larry here. Thank you.
Thank you, Kyle, and I thank you guys for letting me come tell you our story. I truly do feel blessed to be able to be in the credit union industry, an industry that's truly trying to help people, probably much like how you all feel blessed sitting in your seat to be able to help the people of Kentucky. So, so basically, I've got about three stories here that came to mind when Kyle asked me to have this opportunity. The first one, and some of this is things we do every day, and so I just wanted to highlight one big win that we had for a member. First of all, we call our customers members because they are part owners of the credit union. So when I use that term, that means that's a customer / member. But this family came in. They had accumulated a lot of unsecured debt, and we have a debt consolidation loan product. And they came in asking for that product. So we, ran the numbers, and we were going to save the family about $200 a month, real money. But our financial wellness consultant dug a little deeper and found that they actually had equity in some recently or relatively newer cars, or cars that we could use as collateral. So instead of just saving that family $200 a month, we basically saved them $600 a month by using the cars as collateral and refinancing their debt under those. Now, and that's kind of highlights the difference that the credit union makes, is we'd have made more money in the debt consolidation product. But for the members' benefit, because they are part owner, is we went that avenue, presented that option to them, and they were pleased because by refinancing those cars, extending the terms a little bit, their car payment didn't even change. So it was like found money for them of $600. So it really make a difference in their lives. Another example that we have is we call it an easy refinance loan product. It's an in-house product for houses. We had a family come in, and they were in a little higher rate mortgage and wanted to refinance, but their place that they currently had their mortgage would not look at them because the dual income family, but one of the incomes, the person was on disability, and they said, well, your income's dropped significantly, so we're really not going to look at refinancing you at this time. Well, we were able to refinance that family, and save them 2% on their loan. So another success story that we had for our members. And then one last one is something kind of unique that our board decided to do. One of our principles is financial education. And so we established and hired a financial education specialist role. They do some things in-house, but they also go out into the community and into the schools and work just teaching financial principles. So this past year, a few statistics here, they've taught some classes at local high schools, conducted over 10 events, reached approximately 627 students, ranging from third graders to seniors. It doesn't matter, what they want them to teach. We're willing and ready to use this individual's time for that. But they also taught some classes at a place called Ramey Estep's Home, which was a place that was for men and women in recovery. And so another way we can give back and try to help those that are trying to get up off the ground, basically. So it's a way that we can step in for that. But we also conducted something unique in the high schools, 6 local high schools. We did reality fairs. And so the way the reality fairs work is the students come in and we give them an envelope, and now they're assigned a job. So their job may be, I'm a doctor, or I'm a restaurant worker, and so here's my income, here's my family, here's how many kids I have, and then they've got to make lifestyle choices to see how to budget. And so it's a fun game to play, but we call it reality fair because there is reality in there as well. They have unexpected expenses, they have things that come up, and they got to figure things out that, I can't afford the vacation to Hawaii. I need to do a staycation instead, and things like that helps them. So a lot of like I said, I feel blessed to be able to do what we do. A lot of what we do is centered around helping others. And so just, again, thank you for your time to be able to tell my story. So, Jim, you want to?
Great. Good morning. Again, my name is Jim Cash. I have been working with Kentucky's credit unions for just over a year now. But I've spent nearly 3 decades in the credit union movement. I started working at the Walt Disney Company. I worked for Darden Restaurants. I was a consultant in the industry before joining the league here in Kentucky. And I've always been attracted to kind of the passion, right, that credit union folks have towards their member owners. and the compassion that they have for their well-being. And I've got to say, my association with our 56 credit unions in the Commonwealth has just really intensified that feeling that I have. We've been in the credit union business in Kentucky for more than 100 years. So there have been credit unions serving Kentuckians for that long. Right now, we have almost 1 million Kentucky residents who are members of a credit union. Our not-for-profit structure enables a delivery, to Larry's point, of exceptional value and convenience and service levels that are really, again, unprecedented in our industry. Credit unions have delivered more than $93 million in direct financial benefits to Kentucky families annually, and another $36 million in indirect benefits. So we're really reinvesting in the state. Since the beginning of this year, our credit unions have funded more than $1.6 billion in direct loans for Kentucky families. These loans have helped members buy and refurbish homes, fund small businesses, purchase vehicles, and consolidate debt. I'm glad Larry was able to share just a couple of examples of those particular loans. This success is accomplished despite unprecedented challenges faced by our credit unions. Our traditionally conservative financial management principles have really protected us against the volatility of the interest rate market and a recession-like environment. In fact, the credit union industry has never been more financially strong than it is today. Evolving consumer expectations require considerable investment of capital to ensure our credit unions can deliver products and services when and where their members demand. Increased regulatory scrutiny and shifting legislative priorities create additional pressure on credit unions to not only thrive, but in some cases to even survive. Credit unions play a vital role in filling the voids created by other traditional banking providers. Those voids may be geographic. They may be serving disadvantaged consumers, customized product or service offerings, or pricing that's advantageous to the member, not to the financial institution. Not only to say, to Larry's point about making a conscious decision by the credit union to put the member in the product that works best for them and not what works best for the institution. It's of the utmost importance that Kentuckians have multiple financial service options that include the not-for-profit cooperative model. It's clear that Kentuckians who choose credit unions improve the financial health of their families and the health of their communities to the tune of tens of millions of dollars in direct benefits. We want every Kentucky family to have the option to choose a credit union. We'll work hard to ensure our credit unions can answer that call. Thank you for your time, and happy to answer any questions if anybody has any.
Thank you all. We do have a question. Senator Howe?
Yeah, thank you. Thank you for your presentation today. One of the things I believe Larry was talking about with the financial education piece, and one of the things that we struggle with in Kentucky and everywhere, and trying to figure out what to do about it from our standpoint too, is I think that probably none of us have enough financial education coming out of school or anything like that, but we have people that are reentering society either from incarceration or from a drug addiction type of cycle. And I like that you mentioned that you had worked with one of those centers. Does the Credit Union Association have a model or something like that you use for some of your financial literacy pieces with groups like that? I would think it'd be tailored a little differently than what you would go into a high school with.
As far as what we use right now is internally developed. So we just developed it ourselves with what we felt like the needs were. In some ways, budgeting's budgeting, and our view is we have to equip the person. We can't do it for the person, and so we tell them what to do, but they still have to be the ones that own it and do it. And that's where some of the challenge comes in, because sometimes you want to be dad and mom and say, let's do it for you, but we can't do it for them. They do have to own it.
That was kind of part of my question. Yeah. It's somebody that's 38 has a different life experience, even though they may have had some struggles, than somebody that's 18 and doesn't know what it means to balance a household budget or anything like that. So I just wondered if y'all had any sort of template that you had.
They could come hang out with me if they want to see what unexpected expenses is going to feel like.
No comment for
me. Representative McPherson.
Yes, I'm just gonna. You said you all did some education in the high schools through the reality program, and I've taken part in that and served as one of those people that let them spin the wheel and see how many kids they're gonna have, or what they're gonna do, or what vehicle's gonna tear up in what month. And so, do you all have a program where they can come in and be a member before they're graduate high school, where they can have a savings account and do some things like that? Do you all have that process?
Oh, absolutely.
Yes.
Absolutely. We would want to have the parents come in, because a lot of times the children would bank with the parents, but we're open to just the kids coming in as well. So,
Sure.
Yes, sir.
So yes, when I was like 12, 13 years old, my father said, you're responsible for your bills. You pay your own lunchroom money. You pay. It does make a difference in what you ask for Christmas, I guarantee you.
yeah.
I asked for clothes and things that I didn't want to have to go buy myself. So I think the earlier we get those people started, and the better off we do. When they do get out and buy that first vehicle and make those first big decisions, if they've learned how to maneuver and do. There's so many people that don't know how to balance a checkbook, and they don't know how to look at a bank account and realize they just know how to swipe a card and think that mom and dad's going to put money in there and it's going to continue to be there for the rest of their life. And I think that's a life lesson learned, but I appreciate it. Thank you.
Thanks.
I still write checks, Mr. McPherson, in my business and stuff, and all my little younger friends are like, "What are you paying us in Confederate dollars or something other?" They don't even know what a check is. I'm like, "Come on, man! They want me to Venmo them everything and all this stuff." So it's a new world. Well, gentlemen, we appreciate you all coming in, and I always appreciate what you do for our communities. All of us represent communities that have multiple locations of your facilities in them, and we know what you do for our communities, and we appreciate that very much. And we look forward, if there's anything that we can help with or help our consumers with that you all provide services for, we'll be here in the next few months. The session starts before we know it. So thank you all for coming in. Oh, it starts in January. Is that a couple months, or is that? Oh, I didn't know if you knew that or not. We're glad you're here, by the way, Mr. Floor Leader. I think our next group to come up is Kentucky Bankers Association. I see maybe you're down a member or down an associate. So, John, if you want to introduce yourself for the record, and we look forward to your all's statements as well.
Mr. Chairman, members of the committee, I'm John Cooper of the Kentucky Bankers Association. Tim Schenck is our Vice President and General Counsel of the Bankers Association, and Ballard was going to be here today, but he had a couple of assignments, one with the OCC and the other with our executive committee to work on an issue, so he sends his apologies. We'll be at the next meeting.
We're ready for you all to get started.
All right, great. Thank you, Mr. Chairman. Thank you, members of the committee. I know we see you all regularly as part of the 2024 session. Appreciate all the hard work you all put in for this session. I thought we had a great session overall from a banking industry perspective. We passed a number of bills related to consumer protection, bank modernization. We got through the UCC bill, some settlement with minors. So really cross industry wise, thanks to a lot of your all's hard work. So appreciate all the effort you all put in there in getting through a lot of this. One thing I want to talk about a little bit was some of our 2025 session priorities we have coming up. And I know here's a list of the 4 things that we intend to talk about, but it's sort of odd to be in a position as a bank representing banks and serving an association to talk about examiners and taking care of examiner pay. But that's probably our priority number 1 for this session. Because as a banking industry, we want the best examiners to ensure that our institutions are the safest and most sound institutions in this country. As you all recall, we filed a bill this last year, or promoted a bill this last year, talking about examiner pay within the state of Kentucky. And the reality is we face some challenges here. And with all the hard work our commissioner puts in, the reality is that there's some lack of funding there to promote what's happening with the Department of Financial Institutions. Here's some of the figures related to that. So the number of examiners leaving in the last 3 years, we've had 16. Most of our examiners leave after 5 years. Average tenure for those leaving for federal agencies is around 8 years. I think we're floating around eight vacancies right now. I haven't talked to the commissioner about that as recently. But the reality with all this data is that you see is that we are losing our experienced staff, and we're becoming a training ground for the federal examiners. So they're here 3, 4, up to that 5th year. Then they go off to the Federal Reserve, FDIC, OCC for more money. So you can look at the salary comparisons here. So look up through Examiner 1 through Senior 1, those are all kind of commensurate-ish numbers running, and those are usually your first 5 years as an examiner. But then once you make it to field supervisor and branch manager, those are really disparate numbers. When you look at what you'd make at the KDFI compared to FDIC or Federal Reserve, in some of those cases you're making double, if not triple, for the same job within 5, 6 years in there. So one of the things we want to do is fix that. We see matriculation of some of our best examiners to the federal agencies, and we have the money on hand to do that. As part of the KDFI, our banks pay assessments along with the securities industry, along with credit unions, and that sits in a trusted agency account with roughly $6 million in overflow every year. And that money's not part of a sweep. It just sits there. And we'd like to be able to put that money in the hands of the commissioner to allocate that so that we can retain our best examiners and ensure that we have a safe and sound financial institution system here within Kentucky. This also shows where we are a lot of that money comes from the security side. So you can see here, the security side, the numbers are even more vast, with your average examiner, and this is obviously on the federal level, but making $204,000 per year. But what we have to do is make sure that we're able to retain the talent and not just be a training ground for these federal regulators. So really, that's kind of our big push on something we worked on last year. It was hit with a rather large fiscal note, but when you look at it from the perspective of that money already sitting in the trusted agency account and it's not allocated to anything else, really that would all pay for itself. Our second major priority is new market tax credits. Last year there was House Bill 485 filed regarding that. And in short, what these do is incentivizes banks and financial institutions to make investments in communities that need housing. Right now, that number is limited to $10 million per year by statute. The proposal last year was to increase that to $20 million. In short, there was a study done by Kentucky Housing Corporation along with a large national research firm, and it found that there were shortages in housing in 120 counties and 15 area development centers. I know that comes as no surprise to you all. You're familiar with the housing shortages we have here in Kentucky. But one of the things here's kind of the graphics that bring this up to light. And if you look at the far left section of this, these are what the needs are. So looking at area median income, those on the far left are those with the greatest needs. So those with the least amount of income have the most amount of need for housing. And part of that shortage just is that there's just not availability. But new market tax credits create a great opportunity to do that because it has some tax incentives for the financial institutions involved, but also providing housing at a lower rate that traditionally would be involved in a true market. So that's going to be another one of our requests for this session. Another big issue is historical tax credits. I know you all are familiar with those and probably see those in your towns. We have a number of areas that need improvement. But the way that the statute's drafted on that right now is that essentially you have 7 years under a historical tax credit to complete a project. But you're aware of, with post-COVID items, issues like that, it has become harder to get supplies and all the things necessary to complete those projects. And then also historical tax credits are obviously have some sensitivity to them because historical areas have to be rebuilt in a certain form and fashion to keep the nature of the historical sense. So really all we need in this as an industry is some extension of the time period to get those done. If we could shift that from 7 to 10 years, that's not allocating new money. It's just allowing the time period to get that completed. It would allow those involved with that process to not only attain those materials, but also give them the timing to make sure that it keeps the structural integrity of the historical area. And we've seen a lot of these in various communities. You've seen it happen in Nulu and Louisville, but you've seen it also in much smaller markets. But these are really revitalizing historical downtown rural communities everywhere. And these are important. We have, and I should say this at the outset, as to new market tax credits and historical tax credits, we have financial institutions that are committed and want to be vested in revitalizing these areas and fulfilling these needs. But these areas would really help in making sure that these could fill some of these holes with the communities.
And we have examples from Paducah to Pikeville of projects not only that have used these, but ones that want to use them. There's a number out there. So.
And really, the last issue that we bring up is really just a cleanup issue. There's been some questions that have popped up about tax bills and mortgages regarding satisfaction, how notice works associated with that. This is just a cleanup item on where that notice should come from and one that we can address. But I think it's just a minor tweak for clarity with the statute. And those are kind of the real priorities for us as a banking industry for this session. So obviously really focused on one, our revitalizing our communities and making sure their housing needs are met, and then two, really ensuring that the DFI is here for the long term to stay, and that Kentucky banks, as part of a dual banking system, are governed by Kentucky and not necessarily the federal agencies, which are really taking over with our Kentucky banks.
And we realize that the number on the federal side, we're not going to reach that number, but it is descriptive of the disparity when you look at the work that they're doing. And I think if we compensate our state examiners to where at least they can get in the range somewhat competitive with the federal examiners, as I said, they'll never reach that level. They're more apt to stay at home because it's easier for them and working and traveling. There's a number of areas, and we've got good examiners. We've really had a great pool of examiners over the years.
Yeah, and Commissioner Gibson, I think, has done a tremendous job with what she has and her workforce that she has. But we, as a Commonwealth, I think we really need to fund them better so we can be more competitive. In terms of challenges that we see for this session, just to make you aware of, is things that could harm the banking system. Social credit scores, House Bill 452. This was from the 2024 session. You're familiar with this bill probably, but social credit scores are not a real thing. It's a made-up construct, but one that has gained popularity as to some states. But in short, because it's not a real thing, it's also indefensible. And I know the trial lawyers would be really happy to see this pass, probably, because how great would it be to have something and say, well, you have a social credit score and it doesn't exist, so you really can't defend it. But essentially what it will have was a trickle-down effect to our communities and our banks. And where you see that is there are states that have passed this issue, and that somebody may say, well, I was turned down for a loan by a bank, and this is part of a social credit score. There really is no real thing. There's no formula. There's nothing else to base it from. But then what happens is somebody then files a lawsuit and says, well, I found a Facebook post from a teller that said we didn't like this issue. And then ultimately you're left with an indefensible lawsuit. We saw it pop up this last session. Hopefully it will not come up in 2025, but one we wanted to make you aware of, that this is not a real thing. And it really just has no basis. Another one that popped up this last session was House Bill 474 related to ESG investments. So we talked a little bit about the regulatory environment. We realize that as a banking industry, our banks must comport with the requirements of the federal regulatory agencies. The OCC and Federal Reserve have been very outspoken with their requirements to examine banks on their ESG footprint. So what does their carbon footprint look like? Items like that. We don't take a stance as to that, but if something like House Bill 474 were to pass, which said essentially banks are not allowed to consider anything ESG related in their investments or anything related to carbon footprints. It would put them in the unattainable position of deciding whether they were going to meet state law or follow their federal regulator. And as you know, as we noted earlier, talking about regulators, if you're violating your federal regulators, they can really hamstring you really quickly. And if you're having to choose between state law, then they can also be penalized. So Ultimately, this is a federal level issue that we need to keep pressing against regulators there. But a law like this could not pass because it would leave banks in a completely untenable position of deciding whether to meet state law or violate their federal regulators and risk ultimately being shut down. Another issue that we've seen popping up in states recently is interchange. So if you all are familiar with interchange, anytime you swipe your debit card, your credit card, there's a fee associated with that. And that ultimately goes through a system with credit card where it works. I know we went through this with the MCC bill last year. But essentially that covers things like fraud that ultimately financial institutions bear the brunt of. And then ultimately a lot of that goes back to consumers. So you can see here, 93% of consumers are happy with their credit cards. A lot of consumers like their credit card rewards. They like their bonus points, issues like that. But we're seeing that retailers are pushing heavily on banks to reduce this credit interchange, whether it's put as a discount or as a tax reduction. But either way, it's being put under the guise that it's going to pass down to the consumer, and that's not what's happening. So this law just passed in Illinois this last session. Right now there's a lawsuit over that. It's got federal regulators saying it's preempted. It's a mess. But in short, what's happening there is that consumers are not saving, and consumers are up in arms that they're losing their credit cards, their points. And ultimately what you'd see if a law were like that were to pass in Kentucky, and I talked to a bank president that went over their numbers not long ago. Their average accounts for a large number of accounts had housed less than $500 in it. And with those sort of numbers in there and you take out interchange, you would risk Kentucky consumers having to take their debit cards taken away. Because quite frankly, fraud's at record levels. There's a lot of risk inherent with that. And while Chairman Carpenter may like checks, I know that there are a number that do like their debit cards and credit cards, and that may put some things at risk there. So these are issues that we see kind of popping around, being talked about at a national level, and we just want to ensure that the Kentucky banking system remains safe and that our Kentucky banks are able to continue to serve their communities as they have been for decades and centuries.
We is that the last one?
Yeah.
Yeah. Okay. We do appreciate the work that this committee has done. It has always been a very forward-thinking committee. I think you have kept the banking system and the customer safe. I think you're to be commended for that. A lot of these issues that are moving very quickly today on the national scene are being addressed at state-by-state level because Congress has not addressed any of them. It would be much easier to have a federal standard. I don't see that happening anytime in the future, so we're going to continue to see these up. And I will say this, that state legislatures have done a pretty good job of trying to sort it out, and they should be commended for that. Mr. Chairman, we'll be glad to answer any questions that you have.
All right, I appreciate that. One of mine, Tim, was one of the comments you made there about the housing shortage and supply. Everybody wants to talk about housing shortages. And it's kind of a pretty generic statement because it's so broad of income basis and all those things. Kind of fill me in. Just I'm not going to take long with it because we got a few more questions and I know everybody's got to go. But just I kind of want to be curious about what the concept or the thought process is across the Bankers Association of what they're wanting to do and what they're seeing is. I'm sure that's not the $800,000 house that you're talking about that everybody's needing. That's not what my community does, or that's not what I build too many of myself. So I'm just curious of what the comments or thoughts are about this.
Thank you, Mr. Chairman. So obviously these are really the large scale projects. You look at whether they're condos or apartments, things of those nature. But really where we are is, current interest rates, 6-7%. New market tax credits essentially are able to drop that rate sometimes down to zero. Because of the way the tax offset works, which then allows a lot of these to be constructed. And you talk about $20 million in projects, possibly even 40, things like that that pop up could really put substantial marks in this. And these really are low-income housing. And you see it in what's called LIHTC, which I don't want to get overly technical, but low-income housing tax credits. These things all work in the same mechanism. They benefit banks in that they're able to have a tax reduction, but also work with companies like Kentucky Housing to make sure it's the right communities being hit and putting the right people in that really need them. So I hope that answers your question, but didn't want to go too far in detail, but we have the assets ready to be deployed, and they're the ones pressing us saying we want to make these investments, but we know that developers can't do this at 7% interest, 6% interest.
Right.
That makes it
So it's more of like low income housing and probably more of complexes, I would assume, than residential housing is what you're saying.
low income residential housing as well, but not medium income.
Right, and you see the disparate number there on the low end of the income spectrum in the rental market. One of the things that doing these projects right and doing them with appropriate capital is people that are having to rent have decent properties to rent, and that's the big thing. Is that if you're going to be in the rental market for a while, you want a place that's decent to live. And I think that helps us to do that. And the projects particularly, we sponsor Hope of Kentucky, and that project has done some really good conversions of like old schools, other things like that, where people have been able to get some good, decent housing that's clean and workable.
Right. I think Representative Rudy was the first one on my list.
Mr. Chairman, there's so much here that I would like to discuss. I don't really know where to begin, but if I could ask a few questions and comments,
Sure.
With your indulgence. I want to start with what you guys started with, the $6 million for bank examiners that you say is there already. So if the hands are untied and you guys they can spend it, the commissioner can spend it, is that $6 million going to be built back up, or does that make a $6 million ask on the general fund in 2026?
Well, I apologize, Representative Rudy. What I should have clarified is there's plenty of money there to fund it, and I don't think it would be utilizing the full $6 million or even close to it. It would just be some portion thereof to build that up.
And I think that's really the point, is the fact that the money that remains in those accounts of the trust and agency money that was collected by the institutions that are regulated, there's money there to make some reasonable adjustments in the salary, and I think that's our point.
Okay. Now, I could push back on ESG all day long and how we should be pushing back on the federal government and regulations as opposed to laws. I would always pick laws over regulations to follow. But I want to get into this retailer side. I don't think, yes, everybody loves their bonus points and things that you guys incentivize with, but I don't know that people realize how much those swipes and whatnot that you guys are taking out every time from the business, including for the sales tax that the state is collecting. Y'all keep 3% of that as well. And so, basically retailers are losing money collecting tax for the state through that. And I know nobody's sympathetic to big business and whatnot, but, not every retailer is what I'd consider a big businessman. And I also like to point out that when we began the discussion on tax reform, banks were left out because of various reasons, and you guys came back, and then the next year we eliminated the franchise tax. Still waiting for the thank you on that, by the way. But when we look at these swipes and these fees, retailers pay fraud fees to you as well. So you said it was to prevent fraud. What do those fraud fees go to when a retailer is paying a bank?
Well, under Regulation E, the reality is that your customer that comes in and swipes a debit card or somebody steals their credit card PIN number and everything else, the bank has to reimburse that under Regulation E. So they bear the whole brunt of that, whether that's an Amazon purchase or anything else, whether it's $300 or $800. They reimburse the full amount of that. That is paid through this interchange fee. Now, there's nothing a bank can do with Regulation E because they're bound by the terms of that. If you take away the interchange fee, then that means that they bear the full brunt of the fraud, which is ultimately a loss, which leaves them with a business decision of, are we going to offer cards or not? That's sort of the reality. Now, with record amounts of fraud taking place, that's where it is. And it's cards that's happening more and more often. Checks are bad too, but that directly covers that. And most of them, it's a break-even analysis, particularly on the community banks that have provided us with data. And we've shared that with federal regulators so that they understand where that is. And we've got data to support that. But that's really what it does, is it protects the consumer and covers those losses.
Would you be willing to work with the retailers on that? I mean, yes, I see that you got to protect yourself, but I mean, there are other avenues there. What protection does the retailer have that's losing all these fees? I mean, you talk about how it would hurt the end consumer. Well, I see it every day. Now there's a 3% charge when you use a card. Well, that's hurting the end consumer too. They're making that decision, so I think that while Illinois may have gone too far, they were looking at a lot of things like tips and taxing of that and protecting that. I mean, you've taken 2% off. The banks are taking 2%, 3% every time you put that tip on that credit card as well. I just don't know that people are aware of all this stuff in the name of, oh yes, but we get rewards at the end. Great, paid for my trip to Disney, but I would rather have my small business not losing money collecting taxes for the state.
To answer your question, yes, we've always worked with the retailers. We have what we think is a good relationship with them. Shannon, let me know if we don't. I can tell you, but we would definitely do that. I think that's a reasonable discussion to have. I think it's in both of our best interests to work through that particular issue. No doubt about it.
Representative Rudy, you're correct in a lot of that. And I've noticed a lot of places, if you go into like small retail shops, they just charge the 3% to you. I was at a restaurant in the big city of Berea just a couple of days ago, and they had a ticket sign there that said if you use your ATM or credit card, it's a 3% fee on top of it. I'm like, why don't they just add that to the cost of it already so everybody don't see that? But maybe they want the cash, which I'm sure they're paying all the taxes on, Representative Rudy. But I don't understand that concept of it because, in my rental business, we have a credit card machine too because so many people don't like checks. And so we had to make that decision. Do we want to charge them 3% to do it, or do we want to look at that as a business decision? Because, if you start talking about 3% of rents, that's just another fee that's incorporated in your business plan that you really didn't count on. So those are all things that are discussions. And, I understand those, and I've got these rewards on my credit card. I got American Express that tells me all these great rewards, and I'm too stupid to ever cash in on them. It's my problem. So everybody loves this guys like me because we get all these things, and then we don't ever use them. It's like gift cards you see laying around that you don't ever use. So we appreciate that, and we appreciate Representative Rudy and John. We know you guys work any way we can to make sure that it is, because it is a cost. When I worked at the bank, I'll say this, I've worked at a bank for 15 years, and I don't even own a debit card. And everybody's they're like, why don't you have a debit card? I was like, because if I have a debit card and it gets compromised, then that money comes out of my account. And a lot of times you're out that money for a little while until everybody gets understood what's going on. And I know you guys have to pay that as well. Right. With my credit card, I just call and I've not lost that money until something gets accomplished on it. I'm like, if you can be disciplined, pay that baby off every month like this old crazy guy does, then a credit card is your best source because you don't have to worry about that loss. But not everybody has that mindset, I guess.
Mr. Chairman, those issues related to that are going to get worse.
Yeah.
I mean, clearly,
no question.
They're going to get worse.
Checks, like you said, I'm on a little bank board there, and that's all they talk about is how many people are compromising checks and coming up with them, stealing them out of different mailboxes and everything in the world. So that's a huge issue. I think Senator Douglas was our next question.
Mr. Chairman, you've already addressed my question, and it's been answered. Thank you.
Thank you. Senator Yates.
Thank you, Mr. Chair. We pass a lot of legislation, and sometimes we have great intentions that don't actually work into effect. I want to take a second and say I appreciate working with you guys on SB 158, both John and Tim. That's the bill that we passed with minor settlements under $25,000. I'm an injury lawyer, and a lot of times you'll have some minor settlements that are under a certain amount, and going through the court, the probate wasn't efficient, additional cost on to your client and consumer. And so once we passed the bill, nothing happened because a lot of banks didn't want to do it. They didn't understand it. And so just you guys working with them, sending out the emails, educating them, made it actually work. So I just want to take a second and say thank you for carrying it past the finish line after session was over.
Thank you.
Thank you, Senator.
Thank you. You're welcome. Appreciate it.
Representative Smith.
Thank you, Mr. Chairman. I'll be real quick on the new market tax credits. I'm I'm familiar. I've done some of those in the past on some projects. How would you address that? You're talking about state Newmarket, not federal, I'm
Yes.
sure.
Mm-hmm.
How would you address that with us reducing our tax collection to begin with? Because it'd be hard for us to have a goal to go to zero, and you're looking to do a 7-10 year tax credit. Is that something that you've thought of? I mean, we're already going to 3.5 in January, I would assume, with our leadership. Is that something that you've thought about?
Yeah. So on the new market tax credits, I mean, they exist already as in their 10 million per year, and that would be a push to double it. And where that would fall within, we're open to working on where that rate would fall for the tax credit, but the realities are we're just trying to fill the need for the housing.
And to follow up on that, Mr. Chairman, I knew where you was going with it, and I think where the chairman was going with the housing. I think you need to come up with a new plan because the future is we're reducing the tax burden on the with our state income tax. I would put a challenge. We need the incentives, so come up with new ideas on incentives on what we could do as legislators to help boost the housing industry and get more people involved in investing. And following up, Mr. Chairman, real quick, what I hear from bankers in my area is a concern, and we had the credit unions come first, is credit unions. And is there anything, John, that we need to address as far? They're bringing it to me that some of the competition is tough. It's there's a competitive edge. Is that something that we need to be looking as the Kentucky bankers to see what we can do to help in that competition? Because now they're federally regulated. We're not going to be able to change their model, which I'm not after. What I'd like to see is our banks to be able to, they gave illustrations of where they were able to come in and help low income, help somebody that was in a stress. Is that some of the things that you're looking at too that could help our local banks in competition with finding ways to help those that's maybe in stress or has come through difficult times? Is that a fair question? I mean, is that something
Sure.
that you could talk to about, John? Real
Well,
quick.
we don't mind competition as
Yeah.
long as it's fair. And credit unions would say the same thing. We work well. Most of our credit unions are federally chartered in Kentucky, and so we have the General Assembly has limited ways to address that issue. The credit unions have served their need. We have some issues from time to time with the umbrella membership issue because no tax is paid on that, and so. But we realize there's not just a simple answer for that yet. I want to go back, if it's okay, to talk about your tax credit issue. I do believe the General Assembly, it may be more of an issue that A&R deals with, since we are reducing the income tax credit or income tax and per state income tax, and I'm all for that. There are a number of tax credit issues we need to go back and look at, see if there's any adjustments that need to be made. One's the Job Retention Act. Economic development is going to be impacted as of January 1 with this next drop because of the credit that's given on occupational tax. By the locals, there's a give back on the Jobs Retention Act. But there's several of those tax credits that I think probably needs a look-see by the General Assembly to see what the impact is. And I'm sure that they'll do that.
Appreciate it. Senator Howell, I think, was our last question or comment.
Yeah, thank you, Mr. Chairman. I've got a couple. One, I want to follow up on something that Leader Rudy touched on with the bank examiners. I'm assuming that you get in trouble when you assume, right? But I'm assuming that the banking groups can do an actuarial analysis to where you don't bleed that fund to zero by doing the raises and everything.
Absolutely.
Let's assume that you do. Something crazy happens and people hang on at higher salaries down the line longer than you anticipated because what we did worked so well. Who pays that gap then? Do the banks come in then and raise that money amongst yourselves since that's where the money's coming from to begin with?
It's trust and agency money, and we have to fund that agency. So yes, we'd have to come up with a shortfall, and they have made adjustments over the years. I think Representative Meredith's well aware of that. They've made adjustments over the years as to the assessment. and as things have changed. And I want you to understand, and I think Representative Ruger had a great question, and on your follow-up, the last thing we want to do is to bankrupt that trust account. We don't want to do that.
Sure.
But we do. Well, all we wanted to do was to illustrate the disparity, particularly after you get someone that's got 5 to 10 years experience. Those are the people that catch the things. Those are the people that really help to keep your system safe. And so we want to make sure that we retain that.
And Senator Howell, if I may just also respond to that, the other part about that is that there's an argument that if that money isn't deployed back towards the banks, that it's essentially a dual taxation, because obviously they're paying the tax, you're paying tax at ultimately other levels, and then you're paying your examination fee. And if that's not put back into the industry, and true also for securities and the others that are paying that fee, then there's a constitutional argument there. But clearly, the point is to make sure that we have the best examiners that we can have.
Is the total compensation come out of this pool for retirement and health insurance too, or is it just the salary?
I honestly do not know the answer to that question.
I'm glad I didn't either, so I'm glad I'm not alone.
I can't. I'm not going to fudge with that. I don't know. I really have no idea.
Can we follow
but we
up
will
with that?
find out. Yes, we will for sure.
Thank you. And then one other question, just
Yes, sir.
going to the housing question. You talked about the interest rate being the real driver here, but I know in past times I do a lot of real estate work too, and one of the problems we have, especially in our rural communities, is just the economics of building $120,000 to $150,000 house. And the profit level in there, is that something else that this tax credit would address for builders that want to go in and try to build in that range for what we call at home, what we call them starter homes? Is that something?
Senator Howell, if you can build a $120,000 house, I won't come look at it.
Do you want 2.5 walls or 3?
I won't. Yeah.
But it's a problem because of the pricing point in there. And is that part of maybe some of the solution we're looking at? Everybody talks about these condo units and these apartments and everything to live in. Well, we don't do that in Fulton County. There's no demand at all, and there's not enough volume of people to do this. It's going to have to be single family residences that fill some of this void. And I don't know if we were trying to back into any of the solution there on the economics for the builder standpoint. It makes no sense for them to tackle this type of project.
I'm going to make a statement about that because you're exactly right. For what I do, I build quite a bit of stuff, and the houses that I was building 2 years ago, I was given $25,000 for a lot. I'm doing a lot of them. I'll do 20 at a time, and I'm doing. I was $25,000 for the lot. I was selling these 1,400 square foot 3-bedroom, 2-bath with a 2-car garage house for $189,000. I'm now giving $46,000 for the lot in the same subdivision, and I buy 20 at a time. And the house is selling for $265,000. I was making a better profit margin when I was selling the house at $189,000 than I am at $265,000. So in 3 years, the house has almost went up $100,000. And so everybody's coming in my community, in Berea and Richmond too, everybody's talking about affordability. And I'm like, affordability I understand, but what you're really saying is you want subsidized housing. You're not wanting affordable housing because it's affordable to everybody who has a basic income. Right. But the cost of everything has went up over time, include your cheeseburger at McDonald's or whatever you want to talk about here. The cost has went up to where if it's affordable, it's affordable if you have a good paying job, and that's not a $12 an hour job anymore. That's a $20, $25 an hour job to be able to afford a $165,000 house. I mean, a $265,000 house. I'm building a 2-bedroom on a rental. I had a rental house, and I tore a couple of them down, and I'm building a 1,100 square foot 2-bedroom, 2-bath, cute little house, $192,500. And that's the people are running up there wanting to look at it because that doesn't even exist. Senator Yates is looking at it. He's like, I can't even buy a lot in Louisville for $192,500. And so, honestly, that's the call. That's the problem, and that's what's happening. Is why you're talking about people. Financial institutions are wanting to help folks because feasible wise, it doesn't work out. If you've got 2 people making $30,000 a year, they can't afford $1,000 a month rent. I've got a bunch of apartments. My cheapest apartment now is about $750, and that's like. That sounds pretty cheap because the same stuff that they're building brand new today because of the cost, they're having to get $1,200 for it.
Right.
And so, if it doesn't get paid for by subsidized, there's no way to make it work. And, That's a whole. That's
we have a lot of people in this gap with
Yes.
families that need the housing.
absolutely.
And we just, it's a circular argument on where the finance is.
That's exactly right, and where the money's going to come for to pay for the shortfall. That's the biggest issue, because nobody wants to make this investment and try to make this thing work and keep the rent paid, keep the taxes paid, and all this stuff. If you want to make it affordable, I mean, you're going to go bankrupt in just a little bit of time if it's not subsidized, and that's what I keep telling folks. Are you wanting affordable housing or you want subsidized housing? Those are two different things.
And Senator Howell made a good point on the gap, the working gap.
Yeah.
The two people that fall short in that gap, and they're pushed down to the rental market, and then it pushes the people at the bottom of the rental market to the street.
Yeah.
I mean, just being honest, that's where it's at.
Mm-hmm. I agree. Do we have any other questions or comments? Those are all good things. I think that's good topics that we brought up that we're going to be discussing going forward for many years to come, I'm sure, but
Yeah.
it won't be long at all. As Representative Rudy said in January. I'm glad you clarified that for me. We do. Can we have a, yeah, we do. Do we have a quorum?
She walked out, but
Oh, we'll just wait. We won't worry about it. We'll do it next time. We've got our hour and a half. Look there. We've done a good job. We've got our money's worth out of our meeting this morning. Do we have any other comments or questions? Appreciate all you guys coming today and your testimony. Do I have a motion for adjournment?
Mr. Chairman, members of the committee,
sorry,
thank you very
sorry.
much.
Thank you all.
We have our next meeting. I'm sorry. Our next meeting, this will be number 3 for banking and insurance. It almost sets a record. Our next meeting is November the 8th in the same room at the same time. Is that good now?
yeah.
Motion for adjournment? We're adjourned.